Right now, something strange is happening in the silver market, and almost no one on mainstream media is talking about it. Prices look calm on the surface, charts look normal, but underneath that calm, there's pressure building. A lot of pressure. If you've ever felt like silver prices don't make sense anymore, like demand is rising but prices refuse to move, you're not imagining it. What you're about to hear may completely change how you see the silver market. Because this isn't just supply and demand anymore. This is about control, algorithms, and a system that may be stretching itself to the breaking point. Before we go deep, take a second to like this video and subscribe to Finance Forge 360. It helps this channel reach more people who are tired of surface-level explanations and want to understand what's really happening behind the scenes of global markets. If you care about protecting your wealth and seeing through financial illusions, you're in the right place. Now let's talk about COMEX. On paper, COMEX is supposed to be a futures exchange, a place where buyers and sellers discover fair prices for silver. That's the official story. But in reality, COMEX has become something very different. It's a paper market that trades massive amounts of silver contracts every single day, far more silver than physically exists. We are talking about hundreds of ounces of paper silver traded for every single ounce of real metal that can actually be delivered. That imbalance alone should raise red flags. Here's where the trap begins. Large banks and institutional players dominate this market. They don't trade silver the way a normal investor does. They don't care about long-term value, industrial demand, or inflation hedging. They use complex algorithmic trading systems designed to move price, not reflect reality. These algorithms are fast, emotionless, and ruthless. They detect momentum, trigger stop losses, and push prices in directions that benefit the biggest players, not the average investor. Imagine this scenario. Silver starts to rise because demand is increasing, industrial use is growing, solar demand is booming, and retail investors start paying attention. Normally, price should climb steadily, but instead, right at key technical levels, massive sell orders appear out of nowhere. The price suddenly drops in seconds. No major news, no fundamental reason, just a sharp move down that shakes confidence. That's not random, that's engineered. These sell-offs often happen during thin trading hours, when liquidity is low and prices are easier to push around. Algorithms dump huge volumes of paper silver, creating the illusion of overwhelming supply. This scares weak hands into selling, triggers stop losses, and forces price lower. Then, quietly, those same players cover their positions at cheaper levels. It's a cycle that repeats again and again. What makes this more concerning right now is inventory stress. COMEX silver inventories have been declining over time. Registered silver, the metal actually available for delivery, is not as abundant as many people think. At the same time, physical demand hasn't gone away. If anything, it's growing. Industrial users need silver, mints are still selling coins, and long-term investors are stacking quietly. This creates a dangerous disconnect between paper price and physical reality. The trap is that as long as most traders stay in the paper market, the system holds together. But if too many participants demand physical delivery, things get uncomfortable very fast. That's the nightmare scenario for banks. Because if even a small percentage of paper holders ask for real silver, the math stops working. And when math stops working in finance, trust disappears. So how do banks keep control? One word: perception. As long as silver looks boring, weak, or dead, most people won't question it. Algorithms help maintain that perception by capping rallies and amplifying drops. Media narratives reinforce it by calling silver volatile or unreliable while ignoring the structural issues underneath. This keeps retail investors confused and discouraged. But here's the part most people miss. Algorithms are powerful, but they're not magic. They rely on predictable human behavior: fear, impatience, leverage, and short-term thinking. And when too many people step outside that behavior, when they stop chasing paper profits and start demanding real metal, the algorithms lose their edge. They can move numbers on a screen, but they can't create physical silver out of thin air. This is why we're seeing signs of stress more frequently. Sudden price smashes followed by fast recoveries, backwardation warnings, rising premiums in the physical market even when spot prices fall. These are cracks, small cracks, but cracks nonetheless. They suggest that the paper price is working harder than ever to suppress what physical demand is signaling. Another layer of this story is risk management inside banks themselves. Banks aren't invincible. They run models, stress tests, and exposure limits. When volatility increases or delivery pressure rises, internal alarms go off. That's when manipulation becomes more aggressive. Because controlling price becomes a form of damage control. The goal isn't just profit anymore, it's survival of the system as it exists. For everyday investors, this creates a strange emotional trap. You see strong fundamentals, but weak price action. You start doubting yourself. You wonder if you're missing something. That doubt is part of the system. Confusion keeps people passive. Passive participants don't demand delivery. Passive participants don't challenge the structure. At Finance Forge 360, we don't believe in panic and we don't believe in hype, but we do believe in understanding incentives. And the incentives in the silver market right now are not aligned with transparency or true price discovery. They're aligned with maintaining control for as long as possible. This doesn't mean silver will explode tomorrow. Timing is the hardest part of any market story. What it does mean is that the longer this imbalance continues, the more violent the eventual resolution can be. Markets don't stay distorted forever. They stretch, bend, and then correct. History has shown this again and again. If you're still watching, you're already ahead of most people. You're not just looking at charts, you're looking at structure. And structure matters more than short-term price moves. The COMEX Trap works best when no one is paying attention. Awareness alone weakens it. As we move forward, keep asking simple questions. Does the price reflect reality? Does paper volume make sense compared to physical supply? Who benefits when price suddenly drops with no news? These questions don't make you a conspiracy theorist. They make you a critical thinker. Near the end of this video, I want to hear from you. Do you think silver prices are being artificially controlled? Or do you believe this is just normal market behavior? Drop your thoughts in the comments. Your perspective matters, and these discussions help more people see beyond surface-level narratives. If you found this analysis valuable, share this video with someone who is watching the markets but feels like something doesn't add up. Sometimes one conversation is enough to change how someone sees the entire system. This is Finance Forge 360, where we don't chase noise, we analyze structure. Stay curious, stay calm, and stay aware.